Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update, or really midday now. It's 12:19 p.m. Eastern Time, September 25th, 2024. And what I'm going to do in this one is one of those pretty much all-inclusive. Again, it's not all-inclusive, not every single trade idea that I've thrown out recently, but just kind of the core stuff. And as usual, I'll start out with the equity markets, and before we even get into the charts of the stock market, I wanted to reiterate, as I said earlier this week, there was nothing on the calendar that I thought would be market moving until Thursday. That's tomorrow. We've got a trio of things here. Actually, a quad setup. I left one out earlier today when I told you we have durable goods, GDP, jobless claims. Each and all of those, or any of those, have the potential to move the market one way or the other. And then Chairman Powell flap his jaw at 9:20 a.m. after the market opens. So remember, the economic reports come out first. As I said, consumer confidence. Market had an initial knee-jerk reaction to it. It was soft, but that's a non-event. That's a hindsight indicator, in my opinion. And the market just shrugged off whatever initial reaction it had. And so that's it. These are the big ones this week right here. So we'll see tomorrow, and let's roll into what can happen there. So now that sort of segues me into, I'm going to get to the VIX. Somebody asked about it. I'll show you my thoughts there. So I had a couple chart requests. But let me start out with the Euro US dollar, because I threw the trade idea out to you today on the precious metals. And of course, it goes without saying, but if you're new to the site, I'll need to repeat it. To be bullish on gold, for the most part, with few exceptions, is to be bullish on silver and the mining stocks, the gold and silver mining stocks. It's GDX, SIL. They all move together, and they tend to follow gold. The miners and the silver tend to go up in a multiple of gold in the same direction. So, all right. So the post was timely. Got it out to you. We were right at the highs of the day of the euro. And this is, I think, anticipation, may profit taking. Call it what you want, but it's technically induced. So, the charts are the charts. Tomorrow can go either way. Now, here's what I wanted to share. So if it goes the way that I suspect, that the charts indicate, this was the last divergent high here. We had that correction, ended with a divergent low. You get sometimes series that was DH1 correction, bigger divergent high there. The same divergence had been building. Bigger correction, divergent low 1, rally, divergent low 2, bigger rally. This is divergent high 1, correction, divergent high 2, should be a bigger correction, right? All right. What will cause this? Well, if you want to keep it very simple, remember, this is, and I showed you, and hopefully you picked it up in the video. I'll do it again. I mean, in the chart I gave it to you today, but very, very clear. I've covered this for many, many years. The typically unmistakable correlation between gold and you can look at EUR/USD here, which I often do. It's the dollar-euro pair, or you can look at the dollar directly. Think about it. When you look at the dollar directly, if you plug in UUP, then this chart flips upside down. In other words, gold moves inversely to the dollar, so that makes it positively correlated to the euro, because the euro is almost the inverse of the dollar. It's the biggest component of the dollar index. So if the euro is falling, if this pair is going up, that means the euro is rallying against the dollar is falling against the euro. Why has this been going up? Well, as I mentioned, over the past several months, we've seen a tick up. We went from having the market had been clamoring for a rate cut for 2 years now, and finally, or at least a year and a half, finally the odds were baked in a cake that we'd get a 25 basis points, and then in recent months it started ticking up to 50, and then it was locked in right before the Fed cut that we were going to get 50 basis points. Just so you know, let me just toggle over to this real quick for you. As of, it was today or yesterday, before we were pricing in the next cut would be a quarter point. Now, I just pulled this right before the video, we have a 60% chance at the November meeting that we're going to get, and that's early November, so not so far from now. We're going to get a 50 basis point cut, and now only a 40%. Now, these odds are going to change at real time based on what's coming in. That's why we're going to talk about the calendar. But I just wanted to talk about this. So, so you understand this whole correlation there. And again, if you're new to the site, I'll say what I've said 1,000 times. the relationship between gold and the U.S. dollar is simple, because in a vacuum, now we don't always have a vacuum, but if you strip out supply and demand component for gold, in other words, when there's more buying of anything, this is economics 101, more demand than supply, prices go up, right? Simple stuff. But if you freeze that, let's say there were equal amount of buyers and sellers in gold, so the price was not going anywhere. When the U.S. dollar falls, gold will then go up because it takes more dollars. Remember, gold, when you talk about why is gold going, what is gold? Gold is an ounce of gold in U.S. dollars. Here in the U.S. and many places around the world, but particularly here, we're buying it in dollars. So let's just talk about gold in dollars, right? Not in euro or any other currencies. So it's going to take more dollars to buy 1 ounce of gold when the dollar value of the dollar drops. And likewise, when the dollar is increasing against other currencies, the U.S. dollar value is going up, then it takes fewer dollars. And so price of gold will go down. That part of it is simple and immutable, but then you have the other forces in there. Sometimes there's an overwhelming demand, people buying gold. But you can see over time, and I've done this many times, it does not take an expert chart technician to see the correlation. Again, this is the purple line. Hopefully you can see it in the video. If not, it was in the chart today. And sometimes one will turn a bit before the other, but the trends are unmistakable. Look at the inflection points. Look at the overall trend. Gold rising, peaking out right here when the euro peaked, falling as the euro fell, and then both of them turning here. So the turns, again, this is, you can't argue it. The correlation is very, very strong. And again, it's not a day-to-day. You can't bank on it all the time. There are what I call temporary periods of disconnect due to those supply and demand forces that can overwhelm the impact of a falling or rising dollar. And I just like to use the Euro USD, and you might say, okay, Randy, what does the Euro have to do with it? Euro is 57.6% of the dollar index, by far the largest, not even a close second. The yen's the second largest, only 23%. So the Euro and the dollar basically inverse one another because of the huge weighting in the dollar index. So let me turn off the comparison here and now talk about tomorrow. Okay, so far so good. We had a reversal. We're still above trend, the trend line that is in the euro, but it gives us this wedge, gives us a divergent high, and this is simple watch, rinse, repeat stuff. There's no guarantees in any of this, but this is what I do day in, day out. It's a grind, but you just wait patiently, look for the divergent highs, lows, make sure it confirms on other time frames. This is the daily chart here, and it tells me that if we break this wedge, we could have an even bigger drop than these near-term pullback targets that I'm forecasting. Fundamentally, what's going to cause that? Because remember, the dollar and doesn't go up and down in a vacuum just randomly. It's going up and down based against the other currencies. Again, euro being 57.6% weighting in the dollar index. The yen being 23 point whatever, and then everything else, when you add up those two, what is this, 13.6? Something must have changed. I must have typoed this. Oh no, that was right. 13.6. I said 23. My brain fart there. That's still, you're looking, this is on Wikipedia. There's 13.6. So you add up those two, you're at 70 plus over 70%. So that well over 2/3 is just these two. And then you can see the pound sterling is almost 12%, Canadian dollar, and then everything else really kind of doesn't even matter after that. So let's. So that's how things work here. So going back to that, let's go back to the euro, U.S. dollar, and this is what we're talking about because it's going to potentially change the near-term trajectory of the market. In other words, it's either going to build on. There's not been a rally. Post-Fed, there was a one-day rally, a one-day breakout, and we've traded mostly sideways since then. So the market is, in my opinion, waiting to see. Okay, because the best scenario for the bulls, and we have to acknowledge that, is going to be we already got 50 basis points. Right now, there's priced in another 50, although that can change, and might change after tomorrow. But the absolute most bullish scenario for the stock market is we've got the rate cuts. Fed's already promised more, whether it's going to be 50 or 25 at the next meeting, and they're not going to backpedal on what they said. So we know we're going to get a cut. It's going to be 50 or 25, right? Now the market, I believe, and as they should be, are hyper focused on the economic data. You know me, I use indicators that have already kind of turned a corner, and it would be not impossible, but extremely unlikely based on past history. I'm talking about the trends I've showed you on credit card delinquencies and in unemployment nationally, all those turns that are more than just an aberration, more than just a spike up. They show a clear, and again, early, but a trend change at the point where the levels they've turned and have gone up historically mark the beginning of a new uptrend. So there, and again, in unemployment in the U.S. economy, in credit card defaults, delinquencies, things like that. So I'm using that to try to get ahead. Now the market, what makes it a little tough for us to navigate are the day-to-day or the week-to-week reports. So where I'm going tomorrow, and it could be any or all of these, 1, 2, 3, 4 things here. Powell's words, he's God to the market. So they're going to hang on every word that he says. And now it could be a combination of any of these. GDP is so subject to revision, hindsight revisions, just like the jobless numbers too. The government had that huge downward revision. Market initially didn't like it, but then they shrugged it off because they wanted to buy. It was in buy mode. But remember, the market to me is an NASDAQ 100. We're still off. That's the one I'm trading as far as indexes and usually do. Still off the highs. So and I've commented on the new highs and the marginal new highs in the S&P. So let's see where they go there. Obviously, we'll see tomorrow. And so, a downward, a big miss on durable goods or a big miss on GDP, or any of all of these. And again, it could be any one of them. So guys, there's so many, and then of course what he says could reverse things. But where I'm going is weak economic data is going to bake in the 50. But in my opinion, and I'm just giving you my opinion now, that's still, most people are going to say, wow, another 50 base bump. That's huge. Fed, that's they gave us 50. We were only initially, right before that, only 125. And so we liked it. You would think that would be bullish, but I think at this point, the market would react negative to bad collectively, or, all three bad news. That's just my 2 cents. And then that would mean it would help quickly solidify the 50 basis point cut, which would mean dollar down, euro up. So that may change that, the trajectory on the chart I showed you of EUR/USD, which impacts that gold trade and silver trade. Likewise, it goes the other way. If the economic data is all strong across the board, let's just say collectively, it's probably going to tamp down the 50 basis point odds. Is probably going to put it back. My guess is we'd shoot back up to the market favoring a quarter point, especially if all of these are come in at or above expectations. And we can sit here all day long, try to guess it. I'm just going to tell you again. The point I'm trying to make is the charts are indicating that we're going lower here. So that would indicate falling euro, rising dollar, which would indicate that collectively the economic data is strong tomorrow. Again, I'm thinking 5 steps ahead, and sometimes it goes the other way. But for the euro to fall against the dollar, that would mean you'd most likely see the shift from a 50 basis point cut, which right now is favored, as I showed you, 60-40, and you'd see strong economic data, and that would probably at that point knock the odds down on the 50 basis point cut and lock in the 25, or at least put the odds back. There's still plenty of time between now and the next rate cut, so a little over a month, of course. Anyways, that's what I wanted to show you. And so, like anything, stay flexible, diversify. I've put out a lot of trade ideas lately, and I'm juggling a lot of balls. I'm going to do my best to get things out to you as soon as I can on any changes or updates to any trades. But I'm very diversified right now, and think, rightfully so, because, it's at any point in time, I'll usually trade diversified, very diversified, unless there's a big up move I see in the stock market or one particular security. I might focus on that. Sometimes I have concentrated positions in the NASDAQ 100 long or short, and I'm hyper focused on trading the markets, and I'll tell you so. And then I kind of cut back on the individual stocks and all that. It's just like holding, sand in your hands at the beach. You can only hold so much, and it's going to slip through your fingers if you try to do too much. I learned that in trading too, and especially when the markets are moving fast. Right now, I think is a great time to be diversified. And we've been firing on most cylinders lately. Natural gas, wheat, the grains. I'll try to get to some of those commodities in general. And I'm still on that wait and see mode. I'll get to the equity markets here in 1 second. So probably enough spent on that, but just know that that's most likely going to impact those trades. Now I'll get to those. Gold has, since I got the post out to you, broken down. So it's officially a short trade now. It's below the 60-minute bearish rising wedge pattern. Got that post out to you this morning. We were right here. Very timely. It's not much, but we reversed right at that point, as did the euro. You saw that euro US dollar. We were right at the highs this morning when I screenshotted that, and I work hard to get these out to you as quick as possible. It takes me a while to mark up, screenshot, annotate, update these charts, type up, it's kind of rough, scrub it for typos. Usually typos or grammatical errors are in the initial post. I'll try to clean them up later, but I'm not here writing for a Pulitzer. I'm trying to get things out to you. So pardon the typos. And if you see a typo that's a price level, or I say short instead of long, or bearish instead of bullish, correct me and I'll make an update in there. All right, so that's it. Enough on that. But it's important, guys. It's important for both the stock market, the direction of the stock market. Again, I kind of shared my thoughts where things might go. But at the end of the day, charts first and foremost, and how things might play out based on the economic data. And again, there's a trio, actually 4 different things that can move the market tomorrow morning. 3 in pre-market, 1 after, with Powell talking. Or 1 just before he starts talking, I think just before the market opens. So we'll see. All right, moving on. Now let's talk about the markets real quickly. Just brief update. So nothing has changed. This was the downtrend line here we had on QQQ. We had comparable downtrend lines on all the indexes, major ones that I follow and track for charting purposes: QQQ, SPY, and IWM. That's the 2 big large cap indexes I like to follow. The Dow is it's not worth tracking. It's only 30 stocks, so I'll track the S&P, the NASDAQ, and typically the small caps. Sometimes I'll watch the mid caps as well. And so we broke out post-Fed, and as I said, if you look at it on a daily chart, that's probably the easiest way to do it. This was the primary downtrend line right here. A little bit busy chart, but primary downtrend line, breakout, and as I said, we've gone sideways, where that's the breakout, post-Fed breakout, which is also resistance. So nothing, absolutely nothing has changed from the, on the indexes from a technical perspective. And this is, as I suspect, this is the market. No follow through to the breakout. They haven't faded it, so you can't chalk that up as bearish just because it didn't, hasn't been built upon. But I think this is market participants waiting to see on what's going to happen on Thursday, tomorrow. We got all that economic data. So bottom line is, if this market's going to go and run at that, try to backfill the gap and then take that out, which most likely means we're going to go to new highs, it's probably going to be, the catalyst will probably be tomorrow. If the market likes whatever that the results are on those big 4 things coming out tomorrow, if it breaks out and holds above there, especially if this gap is fully backfilled and then taken out, then yeah, QQQs will probably see new highs. And I made mention in yesterday's video, which I'll try to get to. There's a lot I want to cover here. There's quite a few bullish setups right now in the semis. So I'm going to get to that in a second, and I'll give you my thoughts on how far I think they might go. So that's it. So this is just my daily chart. I've been talking about this gap. Let me put it here. I have different boards. There it is. And remember, bigger picture too. We're at the bottom at my market top range, which was laid out before the market even topped, where I figured we'd go with a preferred move up to the top of the range. We came very close there. And then I told you, and I gave you on the same very day, late June 26th, I think it was, a market top range for SPY. pre-Fed, I told you before the Fed meeting last week that if we got 50, then I expected the SPY to make new highs, the S&P 500, but not QQQ. And so far, we're not even close on QQQ. SPY did make new highs, and I expected it to come closer to the final top of that market top range, which fits better and actually helps to even solidify these, long-term price targets I gave you all the way back in June before the market even peaked, because those targets, the price targets, if I move the Fibonacci retracement levels up, in other words, if SPY comes closer to the top of its range too, then we align my price targets. We already hit the first target. The additional targets will line up better with those Fibonacci retracements, and even the Fibonacci price projections that had it getting up there. It wasn't just a random pull it out of my arse kind of number. It was based on, technical analysis, Fibonacci projections, Fibonacci retracements, current momentum, where the divergences are, 101 things, individual stocks, a lot went into kind of coming up with these ranges. So we'll see if they hold. And so post-Fed, where am I going? Well, if we pop, we've got a little more upside. Anything much above that, and of course, the same range on QQQ. I'm wrong. Those will not prove to be the final market top ranges. And I'm talking about the run off the late 2008, early 2023 lows. Something else will be happening. So then I'll adjust accordingly. And just to reiterate, as I said, Fed Day, this is kind of the no short zone for me. There's no reason to add to any short positions or on the indexes particularly. Not only on the indexes. I'm sorry, I'm confusing you guys. I've thrown out quite a few lately. Individual stocks, sectors, financials. I'm still told you I would suspend stops on that. I gave you a suggested stop, but I also said leading into Fed week, best for me, the whole week surrounding the Fed meeting is kind of hold off unless there's something major going on there. Just suspend stops, to sit tight, but do not add. I want to see, as I've been saying, these breakouts fail, and that's at least 3 of them. QQQ, that means we need to come back down and move back down below the downtrend line, which will also take out all this pre-Fed trading right here, right in this range. That was the consolidation week of the Fed right there, Fed day and right after. And then the trend line comes in there. If you want to put a price alert, if you can't do a trend line alert on your charting program, about 471. Again, it depends if and when we get there. It's a pretty good move now to get down there, just so you know. We'd have to hit it, let's just say, for kicks and giggles, tomorrow it'd be about a 3% drop just to backtest the trend line. So if the market doesn't like the economic data or anything Powell says tomorrow, it's going to take 3% just to backtest the trend line. And as I said, I know there's at least one bull on the site. Made very clear lately. Time permitting, I'll talk on that because I've had an absolute field day, done very well shorting the market in the last year. But as many long entries, and that's what those, it's a couple shrinking handful of critics on the site that say you can't short the market. I'll address that later, but. You can't stay short. It's not been a tuck it away and hold on and throw away the key short, nor has it ever been. What this site has always and is always about primarily is swing trading. That's what I created for, not buy and hold investing. I'll just say this real quick. If for those comments that, just buy every dip, the market's going to go up forever, listen to the late, great Jack Bogle. He was the founder of Vanguard, and he was considered the pioneer of index index mutual funds. And his point was find a low-cost index fund, put all your money in it, and don't worry about it, and don't take it out until you retire, and need to start taking money out or diversifying. So that's not what I don't need to tell you to buy an index fund if you've got a 30-year time horizon and you're starting out, you're early, you're young, retiring. If you have a 5-year retirement or less, I think you're going to lose half your assets or more if you're sitting in an index fund following that advice that buy every dip, the market will only go up forever. That's my opinion now, and that opinion is going to be a lot stronger, and the case will be made if and when these breakouts fail. So there's the downtrend line. As I said, about 3% QQQ to backtest. You also have an uptrend line off the lows. which are going to come in together. Remember, this is a 60-minute chart. You don't go you can, but you usually don't go straight down. You zigzag down. So about 3% to get there and back test. And again, if you believe the market's going to new highs, or you just want to swing trade, that's an objective area to buy a pullback on a back test with a stop somewhat below. However, if you want to add to or initiate long-term swing shorts because you are targeting these targets that I gave you back in late June. Remember, I was very adamant and insistent to cover there and game the bounce. Turn around short there, and also to cover here again for the reasons stated. I'll share that later. But if you are looking at these targets down here, again, the odds right now at this moment, I talk about the play-by-play odds, like if you're betting a football game and your team was favored going into the game before the game started, but it's, fourth quarter and they're down by 3, touchdowns, the odds aren't going to be for them at that point in time to win. So right now, the odds, the Bulls, have the ball in their court, and that's what needs to happen. And that's where I think it's more objective to not only add, but to get aggressively short. And if you have shorts, if you took them into the Fed, again, I made clear, be just outright gambling, reckless gambling to go in heavy long or heavy short. Such a big anticipated FOMC meeting. So this is kind of the, nope, hold off. You may not want to stop out. That's up to you. You may have already stopped out. I told you this is an important support resistance level for me, and even bigger up there when that gap, if and when this gap is backfilled. So that's kind of my thing. Wait and see and start really getting aggressive and adding back. It's the scenario I favor just from a pure technical perspective. Again, that's first and foremost. I can sit here all day long and guess and try to anticipate or postulate what's going to happen tomorrow when, if GDP comes in weak or if jobless claims comes in hot, blah, blah, blah. That doesn't matter. I can't trade off the what ifs. That you'll go crazy trying to do it. And it's just crapshoot. It's like gypsy fortune telling. This is what I do right here. I have a bearish rising wedge on the 60-minute chart at resistance. The same resistance level that back here, I told you that was an objective short, and we had a bearish rising wedge, divergent high, and we swung it down there. And then here, I said time to cover the longs based on, we had the reasons cited on the 60-minute chart of the futures, downtrend lines being hit on uptrend lines on NVIDIA and some of the key semiconductor stocks and other things. So this is, again, not to beat a dead horse, QQQ at resistance. So you can make a case to short there. Again, this is the higher probability case here, but this absolutely all day long. This is an identical technical posture to this, and this is what swing trading is about, right? Okay, just quickly, the other charts, as I said, it's not all about QQQ. That's kind of my go-to swing trading proxy, but when you look at the daily chart, you had pretty much equal highs. On that 60, I had a slight downtrend line. Same thing, you have negative divergence. You had divergence building, and you have, these are your divergence lines. You can see it here, right? This was a divergent high, you got that. This was a divergent high, you got that. But this isn't, it didn't reset the divergences. It only extended the divergences. So these are, not to that point, to right here, to this point. This is our most recent divergent high. And the uptrend line, I'm not crazy about it because it's not super well defined. You see where, it's not a great trend line, but it's a divergent high. But again, if we fail this breakout in SPY, then that's going to be make this whole thing a failed breakout. And again, this is still, we're in that realm. I always told you it's, right after the Fed meeting. It's always on the announcements on a Wednesday, then the press conference. It's late in the day. There's just a little time left trading. Friday's still very, can go either way day. And then the dust begins to settle the following week. And this is that following week. And it's usually a few days into there. So it's, like I said, by tomorrow, because it's Thursday with those economic reports, you will know by the end of next week. We'll probably know by the end of tomorrow, is this breakout going to be built upon, or is it going to fail? I put odds on it failing. So, I still have a mild short position from before the Fed in my long-term accounts, and I may add to it, but I'm going to not do anything aggressive until those economic reports out of the way until I see a failure here. Now, I want to show you a few other things. I might have to cover the rest of the trade ideas in another video, so this one doesn't go too long, but I wanted to mention, and this is what I keep harping on, these three big ones: SPY, QQQ, and SOXX, and IWM. Let me get to IWM, then I'll get to SOXX. IWM, this is a small cap sector Russell 2000 ETF. It also had a very well-defined downtrend line off the recent highs, which was also taken out post-Fed. It also, just like SPY and QQQ, has just recently put in a divergent high. Like SPY and QQQ, it's so far started to reverse, not by much. And there's, again, watch, rinse, repeat, right? Divergent high, you got that. Divergent high, you got that. Divergent low, you got that. Divergent high so far. And again, it's a little ways down there. I'll tell you exactly how much, roughly about, again, depends if and when it comes in. If we back test it, about almost 2%. And ideally, you want to see a failure of that. Small caps, a little concerning. That you would think if this whole economic thing, soft landing or no landing, hunky-dory Goldilocks scenario, because the Fed's getting super easy right now. They gave us 50, which is rare. Again, 50 basis point cuts are typically reserved for financial crises or some type of economic, bank failure or something. That's usually when you get them, or a market collapse, market turmoil. We got one, and now we're about to get another one, and yet there, a lot of folks out there telling us the economy's on solid footing. Why? Okay, you have to ask yourself that. And why also are small caps not exploding to new highs with back-to-back, or we haven't gotten the second one yet, but we're about to get back-to-back 50 basis point cuts when they should be the biggest beneficiary because they're the most dependent on borrowing, much more so than large caps. So, you can't write them off, but remember, they're still well off their highs. They peaked years ago. The small cap sector and indexes peaked back in 2021 and are still comfortably below those highs. And so that's it for small cap. So we'll watch those. Oh, and why is it doing it? Well, told you we have a short on KRE, regional banks. I mentioned every time we've gotten up to this range on the daily chart, it's my shorting range. We've had negative divergence. That was, by the way, that one on the 60 was a divergent high, the last one too. Right here, I need to borrow that. Put it there. I had it on the daily. Oh, actually, there was an ADH, almost divergent high. That's what I call it when you have effectively equal highs. It was a slightly lower high, so that's probably why I didn't have it marked there. But it was also at that resistance zone. This one's definitely a big divergent high there, even bigger than that one. So far, this is happening, and this is what's going on with the small caps because they have a lot of the regional banks are in the Russell 2000 small cap index. And so if you want to know why small caps are not doing so hot, despite the easiest Fed that we've had in many years, that's the reason. So and again, that's the fundamental reason. But the technical reason is this is resistance. This is resistance I pointed out back here months ago. We had a double-digit drop. We did it again, and we did it again. And when do we stop doing it? When we start taking out, comfortably taking out the top of that level there. Any new high anytime soon, and this could happen, will still be, well, no, I have to go like this. I have to take the line, pretty much put it straight. So I could see the potential for one more thrust up. It's not what I favor, but if we do, it's going to give you this huge, it's just going to extend this existing bearish rising wedge pattern, right? And that's all it's going to do. As long as we don't take out the divergences, we need to keep below these those divergence lines there. Or we break this trend line, there's your uptrend line, and that triggers the move down to the next target, 53.17, then 50.48, and then 45.60. if and as each of those levels are gone. XLF, still like the financials. Again, this is what helped carry the S&P to new highs, despite the fact that the tech-heavy NASDAQ 100 peaked months ago. Again, we all see things as we want to see. Some are glass half full, guys and gals. Some are glass half empty. The glass half full case says, the S&P is at new highs. We're seeing market breadth participation, broader participation in sectors. But I'm seeing the two that were holding up the S&P relative to QQQ is breaking down, and that's XLF financials. There's the 60-minute chart. I still maintain T4. We hit T2. We bounce. Fed noise right there. That was the suggested stop. But as I said, going into the Fed, my suggestion, my preference is to kind of pull stops for that point in time, wait for the post-Fed noise to settle. We're back down below that level. So you could reinitiate that stop or do that one there. That's our initial entry right here on the breakdown anyway. So you want to stop at entry. That's probably the best bet right now because there's going to be some noise tomorrow, most likely. And so that's what it looks like on the 60-minute. There's a daily. There's the king of the lot right there. JP Morgan, breakdown of that minor trend line I gave you just the other day. So that should kick off the next wave of selling. Obviously, you've got a little support right here. Today's lows around 208 and a quarter. Then there, but then the 200-day moving averages. So when you get the next leg down in the banks, that's going to drag the S&P 500 down and probably cause the breakout to fail. And then, of course, you have healthcare. I've covered this quite a bit recently. Second largest sector. Third largest, I'm sorry. Tech is number 1. Financials number 2. Healthcare number 3. Highlighted this as also as a short trade recently, and now we've just broken that 153.60. Pretty important support. That was a breakout to new highs right there. Really, it was right here. But you had this, we've been testing this support level right there quite a bit recently. And if we close the day, look, remember, this is a daily chart. This was a daily candle. You had a break intraday only to hammer back way up there and close back above it. So 1, 2, 3, 4, 5, 6 yesterday. Successful test. Today is a breakdown. If we close here or lower, as I like to say, the redder the better, then that's a breakdown. That's probably going to take us down to the uptrend line right there. And then if and when the uptrend line goes, that's even a more powerful sell signal right there. And that should take us to the deeper targets. And I gave you yesterday, for those inclined, XBI, biotechs. Let me get over to the VIX. Somebody asked me about the VIX, so let's do that real quick. VIX. Let's go to a 60-minute chart. Let's do that. This is the spot VIX. We had a long on the VIX right here, pre-breakout with an additional entry to be, it was via one of the ETNs or the futures. Had that explosive move in the VIX, came back down. And so all I can tell you right now, and my reply is, the VIX isn't going to go anywhere. Here, I'll show you what I gave you. Okay, it was the reply, I think, to the last post yesterday. Somebody asked an update on the VIX. We'll do in the next video, which I'm doing here. Okay, although the VIX won't really start to move higher unless the stock market clearly starts moving lower, especially if SPY, QQQ, and SOXX all fall back below the downtrend lines they took out on Thursday. Okay, so that's what I just covered on the indexes. I'll get to SOXX in 1 second, then we'll wrap this up. I've recently noticed a 60-minute bullish falling wedge pattern and breakout and current backtest following the recent, here, let me show you. So this is a 60-minute chart of VIX futures. These are the October contracts right there. Remember back here, right here, we had a buy signal based on the futures and everything I showed you before. We caught that move, or at least a big part of it. That hit my final target there, but I closed out early to be safe because I like to exit VIX trades before I close my index shorts, which I did there. We came back down. We put in another, you can see, little bullish falling wedge with what I like to see, positive divergence to confirm it. And we had a nice spike up, hit this resistance level, which is right there, about 21.48. Again, that's the October contract. And now we have another bullish falling wedge right here at support too. This is what's held. The futures have been holding this that's 1760-ish right there. You can see they keep coming down to that level recently and holding that level. And they were just recently broke out and back tested. So you can see what this says. This, meaning this, will most likely happen if Thursday's breakout QQQ, SPY, and SOXX fails. Okay, so that's my update on the VIX, guys. And then, if you're new to the site, you don't trade futures, you can't trade the VIX, the spot VIX directly. There's a lot of VIX tracking ETFs out there. I'm just picking this one lately. You can use VXX or VIXY. There were the targets before. So yeah, we hit my 5th target, although those were the initial targets up to T6. when we hit T4, I said, my preference is to close out there. And if you want to ride up a stop, hold out for that one, you could try to do that. And we did. We hit the next target to the button. Again, these were laid out in advance back here. So 1 hit, 2, 3, 4, 5. And now I gave you, these are the next targets for the next pop. If the breakouts fail, I gave you these back here. So this is that support VIXY. But remember, over time, I like to chart the spot VIX and the futures. This is an ETF. Like all these VIX tracking ETFs and ETNs, they suck over time. You don't want to buy and hold them. You got to be Johnny on the spot. Get in these, get out, because over time they're rolling the futures. They're going to decay like crazy. You're going to lose money. The spot VIX goes nowhere over time. It has long-term ranges it goes to. This is a weekly chart of the spot VIX going back decades, and you can see, but you can't buy this. This is a hypothetical. It's an index. It's based on a methodology calculations, but you can only buy derivatives that track this index, and those derivatives are the futures, the options on the futures, or the ETFs and ETNs that buy the futures and roll them, but have a bunch of expenses and costs and will lose money over time. So long term, this is where we're at. There were 2 periods. This is pretty much the floor of the VIX historically, with 2 periods of extreme low volatility. One was before the financial crisis, just before the market peaked. There was 07, and then this one back in 2017, early 2018. But for the most part, this is long-term support, and that's why one of the reasons we went long the VIX there and milked most of that last explosive rally up. As I mentioned before, many times, this is a line I created years ago that I've noticed. This is where, since 2009, where bull market corrections ended, and this is where bear market ends. That was there have only been 2 real bear markets, at least in the S&P 500, which the VIX tracks. It doesn't track the Nasdaq. It's based off the S&P 500 put and call buying. 2007 to 2009 was obviously a real bear market, the Great Recession. And then COVID was a real bear market. It was interrupted by the Fed and all central banks and federal and global governments. But it was a 36% drop in the S&P, and that's where that one ended. As I mentioned many times, the big drop that we had in 2021 to 2022, we didn't even hit my bull market correction level. We hit that recently, but this was a much smaller drop. So there's wonky things going on with the VIX. And but again, there's no evidence that the bear market that really started back in 2021, 2022 ended. And again, the majority of stocks are below those highs from 2021, 2022. You have this false guise of strength from the Mag 7 due to their ginormous overweighting, the way the indexes are calculated, and the fact that the only handful of $3 trillion companies ever in the world are all in that Mag 7 group. And so they lifted the S&P and NASDAQ 100 to new highs. All right. Remember, the Russell 2000, as the name implies, it doesn't have exactly, they try to track, has 2,000 stocks in there. The Russell 3000 has 3,000. The S&P 500 only has 500 companies. The NASDAQ 100 has 100, and the 100 largest, just like the S&P 500 are the 500 largest in the U.S. NASDAQ 100 are the 100 largest in the NASDAQ composite. And then you go down to the Dow, and you're only at 30 stocks. So certainly not representative of the entire stock market or the U.S. economy. But it's what we trade. We don't trade the economy. We trade the indexes. Okay, so you have the levels to watch on those VIX futures. And of course, like I said, you need to, if you want to hit those targets I just showed you on the VIX futures, you're going to have to see the breakouts, post-Fed breakouts fail. Otherwise, we're going the other way. And last but not least, semiconductors. A lot going on there, a lot to see, a lot to note. I just happen to be on a weekly. So I'll show you, from the long-term perspective, this is this is what we call a secular bull market. It started back in late 08 in the semis when the NASDAQ bottomed in November of 08. Every other index in the all the other indexes bottomed March of 09. But there's our secular bull market uptrend line, one that I fully expect to have visit over the next year. That's why I have very aggressive targets in the semiconductor sector that I believe will be hit. And as I said, it's all perspective. To me, that would be a bullish event. It would just be a pullback, correction back to a primary bull market and keep the bull market intact. And so where some people say you're insane thinking the semis are going to drop 50%, you got the chip acts, you got everything, NVIDIA AI is going to change the world. The charts tell me that's where we're going, we've already started. We're still off that high, but what we need to do to increase those odds and increase, to an aggressive short position is take out this cyclical bull market uptrend line. So that's the secular, longer term bull market uptrend line. These are your cyclical bull markets within there, and your cyclical bear markets. These are 28, 29, 27, 26, 39, 48% drops. So those are your cyclical bear markets within a secular bull, right? And so that's the level it needs to go. So we're comfortably above that, and it needs to go on a weekly time frame. And then you need to take out 188.65. On the daily, this is what it looks like here. You can see the same. You have actually a smaller, shorter term uptrend line here on the daily. Needs to be taken out. That's the one that we covered and went long here when it was hit, and again here. So we're just going to keep bouncing that. However, if we come back down to it again, I think it'll finally go. And I've given you, which I still maintain, these swing targets right here down to T6, which comes in with the trend line about 148. However, that's not going to happen unless this breakout fails. Again, this is the same, the comparable downtrend lines off the recent highs and the semis. Again, the recent highs here. And QQQ was all-time highs. And the semis, it was the same thing, all-time highs, my bad. Very clean, well-defined. Again, lots of reactions. That's what when I say very clean, well-defined. You have all these distinct reactions. Boom, boom, boom. Post-Fed breakout. Is it noise? Well, we'll see. Here's a minor downtrend line right here. That would be your first sell signal. You've got the negative divergences, just like the indexes, that tell me, and we can push up a little higher here. And if we break it, it's not the end of the world. It would certainly trigger a near-term short entry for a pullback trade. There would probably be 5% or so, minimum 5% to come and back test the trend line. But if the breakout fails, meaning we fall back below the trend line, that would be quite bearish. Video is long enough, but I'm going to rifle through here because this sector is a lot to me. It's not everything, but it's a lot. Like I said, you can see tech start to finally do well, but then if the financials, the big banks break down, there's always something. You got to keep an eye on all the important sectors of the market. Again, it doesn't matter what the medical device stocks are doing, or the marijuana stocks, or even the utilities at any one point in time, because they don't move the needle on the stock market. Tech is a big sector, financials, healthcare, those are your big ones to watch. All right, so on to that, what to watch here. I'm going to just rifle through my charts. This is NVIDIA. You can see we are coming up on that downtrend line again. We've had multiple short entries on that downtrend line. We shorted NVIDIA here. It was a swing all the way down to here. We gained some bounces in between, but we milked that biggest drop in years from NVIDIA. We went long there, reversed it, highlighted again as a short there, both on the downtrend line hit and then the break of the uptrend line. Swung it down here. Most recently again, I said hit the trend line. I showed you a long entry there. Time to cover that short. We broke out of a bullish falling wedge to give you a second sell signal, so you could have bought on the pullback to the trend line or covered your shorts there, or in a breakout. We have positive divergence. This is swing trading, folks. And this is what some folks just don't understand. This is what swing trading is all about. You swing these rips and dips. And whether something is in a bull or a bear trend, you can do this all day long. Bullish or bear, just like gold. Gold's been in a longer-term bullish uptrend. Nothing's changed there. It broke out, had a powerful breakout above its previous highs. But as far as the last few months, we've been swinging it long and short. I could be wrong, but I think we're probably at least 5 for 5, 6 for 6. 7 for 8, I don't know, much higher, pretty high success rate. And here we are. Here's what I want to get at. We're coming up to the downtrend line again, and you have my reshorting zone. However, you heard me speak caution. I'm throwing caution into the wind unless, where did it go? Here it is. Okay, right there. We see the breakouts fail. So I just want to say I'm less eager right now to short, but You know what? I'm tempted. I told you before, this is where I started scaling in, and I told you when I did that, I wasn't going to add when we pulled back because there was no point. I took initial lot there, a small lot. I would only add up to the top of the range, and now, yeah, I'm going to stick with that plan. And I'm going to show you why here in a second. I think, number one, here you go. Here, yeah, negative divergence right now. You're coming up to the trend line. So, yes, let me unequivocally say this is an objective short entry. We're not all the way to the trend line yet, but close enough. And I don't want to miss the turn. So I'm going to pause this video. I'm going to add to my NVIDIA short right now. Okay, did that. Stuck to my trading plan. Now let me show you the things that I'm seeing in the sector, and which are bullish recently. Well, quite a few, not everything. Now Intel, that one was a long, has been a long, my only long in the sector, other than bouncing long, I should say. I'm talking swing trades. I know I'm confused the hell out of everybody. I'm talking position trades. Bought it on support, highlighted there, coming up to that first target. My goal is to sell, as I told you, just below that level there. Okay, so that's that one. Again, you've had plenty of long ops, including NVIDIA, long half a dozen times or close to that over the last few months, even since the top. As well as the other big one I'm watching. But what I'm going to do here real quick, and we're going to wrap this video up, is take a look at the sector overall, just the components of SOXX. But there's Broadcom off the 200 days twice, big rally. So here's what I'm going to show you quite a bit of bullish evidence that's kind of giving me pause. And again, my strategy. I'm not doing anything hard here in the video. I had to because that was part of my trading plan. I don't see any reason to modify it yet. I am not aggressively short that stock yet, nor would I be until I see some of these fail. So what I'm going over is SOXX, as I've been repeatedly saying, needs to fail this breakout right here. Then even better, needs to fall, take out the primary uptrend line. That's kind of the all-in moment. When that level's taken out, 194, I think the trend line will do the trick, but 194.77, very good price support. And then we go on to my long-term targets I give you on SOXX right here, much deeper targets, right? The odds will shoot up. So right now, the odds aren't great at the moment because we just broke out. We could easily, rally from here. Now, here's the thing. If I'm right on where the market's going and where the semis are going, it's been my experience that especially early on in a new bear market, a new downtrend, and I'm going off, and I haven't wavered on that these highs, the recent bearish engulfing candles, divergent highs in both QQQ, the NASDAQ 100, and the semis and NVIDIA, that they were the highs, end of a bull run that started here, right, with a new bear run to come. So going off that, it's been my experience that bullish technical events, breakouts, positive divergences, things like that have a much higher failure rate. They're almost it's fodder or bull. It's food for the bull trap in a bear market. Just like in a bull market, you have a lot higher failure rate of these bearish chart patterns and breakdowns. Just as they start to get going, that's usually when they fail. Not always. And again, you can swing trade all day long in any trend. These are divergent highs. These are all double-digit drops, many, if not all, of which we caught. But the primary trend's been bullish. So let me just rifle through the components of the semiconductor sector. I already covered NVIDIA for you. Again, on the 60-minute chart, we're coming up to resistance. So this one I do like right now as a short. As I said, I just added to that. Taiwan Semi. This one is pushing the upper limits right here. This was a big divergent high, bearish engulfing candle. So that is a top, in my opinion. If that level is violated, that is no longer a top. You know what? I mean, look, I highlighted this in a lot of these breakdowns. It was a drop of 32%. So but it won't be the top of a trend. And we covered like everything. I didn't have this one individually, but I covered it in the video. 200-day moving averages and my 134.88 key support price target was hit. So this is where we reversed all positions. That was August 5th. Again, no coincidence there. We're at really good resistance, big old gap. And anything much above that, it probably will then go to take out that previous high. But it hasn't. As I like to say, resistance is resistance until unless taken out. But it's, a pretty strong looking chart right now, especially with the move up and the retracement off that divergent high. But you can't, right now that's still the top, and I'm going off that as of this point in time. Broadcom I already covered. Bullish that it took out this downtrend line, absolutely. But if it fails it, then that's going to be a failed breakout. That'll be bearish. And then again, lights out when this trend line goes on a solid, special weekly closing basis. We've had a couple dips below. Needs to take out the 200-day moving averages, which they keep buying it on, and that's where we bought it on, or I highlighted that as such. And then that level goes, and then you go to the next support, and it's lights out. Once we break this, that's the primary uptrend line. Then we go a lot lower. We're coming down at least here. So I'll tell you from where we are now, if that happens, I see this stock losing almost half its value down to that 91 level. ASML, bullish falling wedge. This is why I wanted to do this video. Nice, clean downtrend line, positive divergence there, everything I like to see. But again, bull fodder if my longer-term outlook is correct. So maybe we break out, then get rejected there. Maybe we never break out. It hasn't broken out yet, but I'm giving it to you as a setup. There's a bullish falling wedge. We could get rejected again and later break out of the wedge, so keep an eye on this one. But what I look for in a bear trend is see these divergences get taken out and see these breakouts fail. That's what I think will probably happen, but it hasn't happened yet. And until it does, you can't get too bearish. AMD had, here's another one. So I'm seeing just kind of more and more recently. I expected, again, in position for the bounce in these semis off the last big drops. August 5th, and then that second pullback there, as I showed you, from things hitting trendline support, the sector itself, SOXX. But what I'm seeing is, will the real whipsaw please stand up? We broke the primary trend line there, and it's well-defined, very well-defined trend line. But then we broke back above it there, and then we failed it again. Now we're back above it. So it's kind of just sloppy. And as of this time, if you're playing those real-time odds, like the football game in the fourth quarter with one team up, by 3 touchdowns, you got to put the odds right now to the Bulls. It's at resistance. I want to see it lose this trend line, but it's gone through it so many times, it really needs to take out that recent low. But I just wanted to show you that this is kind of, at least at the moment, tempering my desire to add a lot more short positions on the indexes, on the tech stuff, the NASDAQ and the semis. Although, like I said, NVIDIA is a king, by the way, guys. So the rest of them don't matter. They're rallying because NVIDIA is rallying. If NVIDIA gets rejected here, as I expect, where I just showed you up to the downtrend line, not much above there, then the rest of these are going to follow suit sooner than later, kicking and screaming, going down with it. Texas Instrument, divergent high, snapback rally. Really, no opinion. It's a bearish chart. I think it goes down, but I'm just showing you what things look like. This is Qualcomm. Qualcomm, you can do the same thing here. Put a downtrend line, which it just broke out of. Need to see that breakout fail. Applied Materials, an almost divergent low. Remember, I call it, have ADH, ADLs, almost divergent low. That was an almost equal low there with positive divergence there, higher highs in the indicators. But it's a big resistance. That yellow line was a yellow line for a reason. I think that's important support. And, over time, again, I'm viewing this bearish engulfing candle, divergent high, trend line break. A lot of evidence that was a top, and I'm treating it as such until unless we take those, all these, a majority of those bearish engulfing candles out. ADI, analog devices, kind of still under. All the semis are below their highs. Micron, big ass bearish engulfing candle, massive one, divergent high, way off its highs. But also, if you look at it where it's at today, that was a correct call, shorting it there, or highlighting that as a short trade. 46% drop. And right to, and it's gained. It had a brief undercut, but it's back above the trend line. So this, guys, this needs to fail. This we have a breakout of the bullish falling wedge, that downtrend line right there, in this positive divergence. We broke out. We've regained the trend line. So these are the things I need to see Micron fail. I need to see collectively the majority of these fail these bullish chart patterns. Otherwise, we may be going to my semi-long-term targets, SOXX, sometime next year, early next year. But it's going to be hard to see those targets, especially the deeper targets, be hit by the end of this year. If these guys continue to, rally off these. This is, like I said, this is a bullish technical event right here. This was very bearish, but again, how much of that move is priced in? So All right, I could go through each and every one, but you're going to see a lot of the same things. Bullish falling wedges, clean downtrend line patterns. This one hit support. They had we had a correction. So $1 million question, were these divergent highs the high or just corrections in an ongoing bull market? I still believe they were the high and that these breakouts will fail. There's plenty of resistance overhead. And again, this was much, much larger negative divergence building for a long time on Lam Research than the smaller divergence. And look, guys, if I'm confusing you, another way to trade, if you're a long-term swing or trend trader, focus primarily on the weekly charts. Let that be your guide, because the shorter term charts, especially once a trend has changed, they're going to give you a lot of false signals, a lot of buy signals, breakouts, bullish divergences that aren't going to play out. This overrides everything, in my opinion, what's happening on the weekly charts. I probably should have covered that on all the other stocks I just showed you, but they're all going to be the same. Big, big, big negative divergence. Not anything remotely close to positive divergence, but we're also at a pretty damn good support level we hit. This was the all-time high right there. Got rejected again. This was a breakout to new all-time highs. This is simply a back test. So I know I'm beating a dead horse here, but I think you understand now what I'm saying. So in the coming weeks, if all the breakouts I just showed you on those semis that have broken out, some haven't, but the ones that have broken out or are poised to, if those breakouts fail, pretty much if we just move below the recent lows, which again, keep it super simple. I covered a lot of charts here. I watch a lot of charts, but if you only want to watch one, just watch the SOXX. And if the SOXX semiconductor sector takes out this trend line, and especially its recent lows there at 194.77, my odds for those long-term targets that I gave you are going to shoot up sharply. And it's going to be well north of probably 70%, in my opinion, that we're going to go hit these long-term targets if that level, the recent lows, get taken out. All right, long video, lots of stuff. I'll wrap it up here and I'll cover the other stuff, treasuries, agricultural commodities, individual stocks. I'll cover those in another video. This has been Randy Finney with Right Side of the Chart. Have a great day.